For more than 100 years, Harley-Davidson didn't just sell motorcycles. It sold belonging, the kind you feel in your chest when the motor settles into that familiar heartbeat. And dealerships became the gatekeepers. Now the numbers are sliding, sales are down, shipments are shrinking. The company is tightening the pipeline just to stay upright, and everyone has the same reflex. Blame the economy, blame rates, blame corporate. But what if the real problem is closer to the showroom floor? Because some dealers didn't lose riders, they pushed them away. Ignore this, and you could end up overpaying, stranded, or walking out empty-handed from the bike you thought was yours. In February 2026, Harley-Davidson, Inc., confirmed what riders had already sensed walking through half-quiet showrooms. This wasn't rumor, it was printed in black and white. Global retail sales for 2025 came in at 132,535 motorcycles, down 12%. Wholesale shipments fell 16%. The core motorcycle division posted an operating loss of $29 million. Fourth quarter revenue dropped 28% compared to the prior year. Production was trimmed nearly 20% to prevent excess stock from piling up on dealer floors. North America showed a small late-year lift, but the full year still finished down double digits. Europe softened. Asia-Pacific contracted even more. Financing shifted as well. Harley-Davidson Financial Services restructured major receivables, sent a billion-dollar dividend upstream, and tightened retail lending exposure. The balance sheet looked leaner. Approval standards looked stricter. Meanwhile, the electric arm, Livewire, reported a $75 million annual loss while moving just 653 units. And if hearing the real numbers instead of dealership optimism is exactly why you watch this channel, go ahead and hit like, drop a hype, and subscribe. It tells me to keep digging this deep instead of skimming the surface. Now layer in elevated borrowing costs, cautious consumer spending, and a strong used bike market pulling buyers away from new inventory. Pressure builds quietly at first. Shipments slow. Floor traffic thins. Margins narrow. Fixed expenses stay put. And when you step back from the spreadsheets and earnings calls, one unavoidable question starts forming. If this pressure has been building for years, what role did the retail experience itself play in accelerating it? Because the story didn't start in 2025. And once we look at how customers were treated long before the downturn, the entire conversation shifts. This didn't start with tariffs, it didn't start with interest rates, and it sure didn't start in 2025. It started with what riders remember. For years, people walked into Harley dealerships expecting something rare. Not just a motorcycle, but a moment, a handshake, a welcome. That feeling that the brand actually saw you. And sometimes that's exactly what they got. But other times, the experience landed like a cold engine on a winter morning. A salesperson who scanned you before saying a word. A price quote that felt padded before the conversation even began. A finance office that turned excitement into tension. A vibe that quietly said, if you're not already one of us, you're not really one of us. And that kind of thing doesn't vanish when you leave the parking lot. It follows you. Ask riders who bought during the early 2000s. Boom, and you'll hear the same pattern. Back then, demand was so strong that some dealerships didn't have to earn the sale. They could add markups. They could act like the bike was a privilege. If you didn't like it, someone else would. That approach works in a feeding frenzy. It fails the second the market cools. Today's buyer is different. They've lived their whole adult life with transparent pricing, online reviews, and instant comparisons. They don't want to be handled. They want to be treated like a human being with choices. So when the vibe feels off, they don't debate, they don't negotiate. They walk out, drive home, and tell the story later. And those stories stack. To be fair, plenty of Harley dealerships are outstanding. Some are the heartbeat of their towns. But reputation isn't built by the best stores. It's shaped by the most common experience. A younger rider walking in today may already be carrying second-hand warnings from an older brother, a coworker, even a parent. They'll overcharge you. They don't care unless you look the part. They'll pressure you in the back office. Whether that's fair or not doesn't matter. Because when money got tighter in 2023, 2024, and 2025, the riders who were already hesitant didn't stretch. They remembered. And here's where I want to hear from you. What's your own experience walking into a Harley dealership? Welcome, cold shoulder, or somewhere in between? Drop it in the comments, because sharing these stories is how we see the patterns nobody in the boardroom will admit, which exposed how fragile Harley's relationship with the next generation really is. And it brings us to the next shift that dealerships can't negotiate their way out of. For years, the typical Harley-Davidson Inc. buyer was easy to picture. Usually a man past 40, established career, finally at a place where reward matched effort. He wasn't just buying transportation, he was marking a milestone, a promotion, a business sold, kids grown. The motorcycle was a symbol that he had earned his freedom. Through the early 2000s, that equation worked. Baby boomers were in peak earning seasons. Credit flowed. The cultural pull of a big American V-twin still carried weight. Touring rigs and long, low cruisers rolled out the door steadily, but time doesn't pause for tradition. By the middle of the last decade, the average buyer had moved into his mid-50s, then into his 60s. Many still loved riding, but they upgraded less often. Some rode fewer miles. Others stepped away entirely, shifting attention toward retirement planning, grandkids, or health concerns. The next wave never matched the size of the last. Younger adults grew up in denser cities. Insurance premiums climbed. Student loans followed them well into their 30s. Priorities leaned toward flexibility, travel, technology, experiences that didn't require a long-term loan. A heavyweight touring motorcycle carrying a price tag north of $25,000 felt distant, even to those who admired it. Meanwhile, the used market filled with well-kept bikes owned by aging riders who simply weren't trading up. Replacement cycles stretched longer. Entry costs stayed high. This wasn't a dramatic crash. It was demographic gravity, a shrinking core audience, fewer first-time heavyweight buyers, higher average transaction prices. When the math shifts, every layer of the system feels it. Corporate adjusted strategy, but adaptation at the top is only half the story. The real test happens on the showroom floor, because it is where this stops being a feelings conversation and turns into architecture. In 2025, Harley-Davidson wasn't making decisions to keep dealers comfortable. It was making decisions to keep the company breathing. Inventory discipline, cash preservation, balance sheet repair, protecting returns for investors who were starting to get nervous. And the evidence is everywhere. Wholesale shipments were cut 16% year over year. Dealer inventory ended the year down 17%. The factory deliberately tightened the pipeline to match the slower retail movement. That isn't confusion. That's a controlled retreat, because the old Harley model was built on one thing: volume with leverage. Dealers ordered big, floors stayed packed, and Harley-Davidson Financial Services kept the engine running by making approvals easier and payments feel manageable. That system worked when demand was strong and buyers were willing to stretch. But in 2025, global retail demand fell 12%. Affordability cracked, foot traffic thinned, and tariffs didn't just raise costs, they squeezed margins right where Harley needed breathing room. So corporate pivoted, not toward growth, toward survival. Harley's financing arm made a major move with institutional partners, including KKR and PIMCO. It shifted receivables, reduced debt exposure, and sent a $1 billion dividend back to the parent company. HDFS earnings became the shock absorber for a motorcycle division that posted a $29 million operating loss. From a boardroom view, it was smart. From a dealership view, it changed everything. Because once corporate tightens wholesale shipments and starts policing incentives, local stores lose the one thing they used to rely on: flexibility. And flexibility is what keeps a high overhead business alive. Rent doesn't shrink because inventory shrinks. Payroll doesn't vanish because allocations get cut. Floor plan interest still hits every month. Insurance, utilities, service departments, tech pay, all of it stays. So now you've got dealers built for a high throughput era trying to survive in a margin first era. That mismatch is the fault line. North America did see a 5% retail lift in the fourth quarter, helped by touring strength, but the full year still finished down 13%. Meanwhile, profitability was pressured by tariff impact and incentive spending, so corporate protected the top line where it could. But every time the factory protects itself, the retail layer absorbs the stress. And that's why this isn't just dealers versus corporate. It's an old system colliding with a new strategy. And once that collision hits high fixed costs, it stops being personal, it becomes math. And the math is brutal. And if you're running a dealership, or even just a rider who's felt the pinch of rising prices, hit that like button and drop a comment sharing your experience. Keeps us honest and shows you're paying attention to the forces shaping every Harley in your town. This is where the anger fades and the arithmetic takes over. In 2025, Harley-Davidson reported global retail sales of 132,535 motorcycles, down 12%. Wholesale shipments fell even harder, down 16%. That's not a bad quarter. That's the market getting smaller. Now put yourself in the shoes of a modern Harley dealership. This isn't a mom-and-pop shop with a couple used bikes out front. Most stores today are built like full-scale retail complexes. Prime real estate, a showroom that has to look like a lifestyle museum, 20 to 40 employees, a service department with techs who aren't cheap, a marketing budget, demo bikes, events, customer lounges, branded gear walls, and the big one, inventory financing. Millions of dollars in motorcycles sitting on the floor, often financed through floor plan credit, tied to Harley-Davidson Financial Services or partner lenders. Here's the part riders don't see. Floor plan interest doesn't take a day off. Payroll doesn't pause because foot traffic slows. Property taxes don't care if a road glide sits for 90 days. So when corporate cut dealer inventory 17% by year end, it helped stabilize the pipeline. But it also meant fewer units available to generate the gross profit dealers need to cover fixed costs. And then the margin squeeze hit. Harley's gross margin dropped from 28% to 24.2%. In the fourth quarter, gross profit actually went negative. Tariffs, incentives, and lower operating leverage wiped out the cushion. And when the factory loses margin, the dealer usually loses support. Now stack the pressures: retail demand down, financing approvals tighter, used bike prices softening, incentives less generous, inventory moving slower. That changes the break, even math overnight. A high overhead dealership survives on velocity. If a store needs 25 to 30 new bike sales a month to stay healthy, and the market now supports 18 to 20, the business doesn't struggle, it bleeds. And it bleeds quietly. Service becomes the lifeline. Pre-owned becomes oxygen. Events become an attempt to manufacture momentum. But when North America retail is down 13% for the year, even strong operators start feeling the walls close in. This is the point where closures stop being shocking. They become inevitable. Not because anyone failed morally, because when fixed costs stay high and demand stays lower, the corridor narrows until there's nowhere left to stand. And that's why the next question matters more than the numbers. When the math turns against you, who actually put you in that position? Now we pull emotion out of it, because this is the point where most channels lose credibility. It feels good to point a finger. It feels satisfying to pick a villain. It makes the story cleaner. But real financial pressure is rarely clean. Let's start where the money actually sits, at Harley-Davidson Inc. In 2025, global motorcycle shipments were reduced by 16%. Dealer inventory was cut by 17%. Worldwide retail demand dropped by 12%. The core manufacturing division reported an operating loss of $29 million. At the same time, the company ended the year holding roughly $3.1 billion in cash. Through adjustments inside Harley-Davidson Financial Services, debt exposure was reduced. About $1 billion in dividends were moved upstream to protect liquidity. That is not recklessness. That is defense. Corporate leadership shifted from chasing volume to preserving margin and safeguarding capital. When the environment tightens, survival outranks expansion. But every action at the top creates force below. Now look at the dealer network. For years, many stores built larger showrooms, expanded service departments, added lifestyle merchandise, and staffed for event-driven weekends. That formula thrives when buyers are plentiful. It becomes heavy when traffic slows. Some operations leaned on aggressive financing approvals, elevated trade-in values, and high unit turnover to cover payroll, rent, utilities, and interest. When lending standards stiffened and monthly payments climbed, That momentum stalled. Not every dealer stretched too far, but the system was engineered for acceleration, not restraint. Now zoom out further. The average Harley customer continues to age. Younger riders face higher insurance premiums, higher borrowing costs, and different lifestyle priorities. Touring models, historically a profit backbone, softened before stabilizing late in the year. International markets underperformed. Add tariffs, add elevated interest rates, add tightening, discretionary spending. Those forces are bigger than any showroom. So who carries responsibility? Corporate tightened supply. Dealers carried substantial fixed overhead. The market recalibrated demand. No single hand caused the strain. But when strategy shifts, costs stay high, and buyers hesitate, pressure compounds. And compounded pressure does not ask who is innocent. It reveals who was prepared. That distinction is what most people are missing, and it changes how we interpret the word crash entirely. So now I want to hear from you. Who do you think was more responsible? Corporate, dealers, or the shifting market? Drop your answer in the comments, because seeing how riders and insiders interpret this pressure is exactly what teaches the real story. And as you're thinking about that, the next part takes us deeper, straight to the numbers, the closures, and the shocking reality of who's actually paying the price. So what does Harley will crash actually mean? It is not revenge. It is not cheering when a family business turns off the lights. And it is not some twisted celebration of struggle inside the riding community. It is consequence. When we say certain Harley-Davidson, Inc., dealerships are getting what they deserve, we are not making a moral argument. We are describing alignment, or the lack of it, between structure and reality. Look at the numbers from 2025. Shipments reduced by 16%. Global retail sales down 12%. The manufacturing division reporting an operating loss. Meanwhile, corporate leadership reinforced liquidity, protected margins, and restructured Harley-Davidson Financial Services to limit financial exposure. That was not retaliation. It was recalibration. But recalibration reveals weakness. Many dealerships were built during years when demand felt endless. Massive showrooms, lifestyle merchandise walls, full event calendars, staffing levels designed for packed Saturdays. Heavy reliance on finance buyers with long loan terms. That blueprint works in expansion. It strains when affordability tightens and traffic slows. Some operators adjusted early. They leaned into service departments. They strengthened pre-owned inventory. They reduced overhead before pressure became panic. Others waited. They believed the old rhythm would return. Here is what crash means in this context. If a business model is flexible, it absorbs impact. If it depends on constant growth, it magnifies shock. That is not cruelty. That is economic gravity. The word feels harsh because it removes comfort. It denies the easy narrative that someone evil flipped a switch. But markets do not hand out punishment. They deliver feedback. Corporate strategy changed. Consumer behavior evolved. Costs remained elevated. When those three forces intersect, outcomes follow structure, not moral judgment, mathematical consequence. Once we understand the responsibility, the argument ends, but the story doesn't, because the industry is already moving into its next chapter. The breakdown of one business model does not signal the death of a riding culture. It signals transition. For decades, the traditional Harley retail blueprint revolved around massive real estate, deep floor inventory, and constant unit turnover. That formula was born during peak touring demand, easy credit approvals, and a generation of riders entering their highest earning years with confidence. That wave is no longer rising, it is leveling. So what comes next? First, leaner operations. When Harley-Davidson, Inc. reduced shipments by 16% in 2025, that was not a temporary reaction, it was a declaration. Volume will no longer outrank margin. Cash stability now carries more weight than expansion. Bragging rights. Expect tighter inventory control, smaller footprints, and fewer oversized lifestyle campuses built on borrowed optimism. Second, service and pre-owned strength. As new motorcycle affordability narrows, certified pre-owned units and service departments become financial anchors. Shops that shift from weekend spectacle to long-term ownership support will steady themselves faster. Wrench time becomes more valuable than ribbon-cutting events. Third, financing discipline. With restructuring inside Harley-Davidson, financial services and tighter lending standards across the industry, approvals favor stronger credit profiles. The era of stretching every deal to meet monthly targets is fading. That changes who walks out with keys. Fourth, product recalibration. Touring motorcycles remain influential in North America, but future growth may not resemble past decades. Smaller displacement machines, entry-level access points, and electric experimentation through Livewire Group, Inc. will test whether the brand can attract new riders without erasing its identity. Who benefits in this environment? Operators with modest leverage, dealers embedded in their communities, customers who prioritize service relationships over showroom theatrics. This is not extinction, it is filtration. The network will likely become smaller, but potentially stronger per unit. Weak operators may exit. Strong ones will consolidate share. The brand's survival won't depend on nostalgia, it will depend on adaptation. This isn't a funeral, it's filtration. The structure may change, but the culture survives only through the people inside it, which brings the responsibility to us, and that is the next conversation. But before that, if this perspective is changing how you see the Harley world, hit that like button right now. And if you want to support us even more, get early access to deep dives like this by becoming a member. Your engagement lets us continue breaking down the numbers, the strategy, and the reality the dealerships won't tell you. So now I hand this to you. After the shipment reductions, after retail demand softened, after restructuring inside Harley-Davidson, Inc., after the pressure placed on Harley-Davidson Financial Services, after thinner margins and heavier operating costs at the store level, where do you land? Are certain dealerships experiencing the outcome of their own decisions? Are they collateral damage in a corporate recalibration? Or is this simply a market correcting years of excess across the board? Step outside the headlines and look at your hometown. Has your local store changed its tone? Are prices holding firmer than before? Does inventory feel tighter? Are weekend events quieter or more focused? Or is your dealership operating stronger than ever? I am not looking for quick reactions. I want lived experience. If you are a rider, describe how your buying journey feels today compared to a few years ago. If you work inside a dealership, explain what pressure actually looks like behind the counter. If you walked away from the brand, tell us what pushed you. This conversation is not about outrage. It is about direction. Share your position below. Challenge someone respectfully. The future of this culture will not be shaped in corporate offices alone, and this shift is still unfolding. If this video changed how you look at dealership closures, don't stop here. Watch the next video to understand what this means for the bikes themselves and future ownership costs. Subscribe and join the rider group that wants clarity, not hype.